So we're going to start chapter 1 today in this course. Yesterday we were talking about accounting and accounting professions, and I was trying to introduce you to the world of accounting. So now we're actually going to go into the textbook that we use and get into the first concept about accounting. So Accounting in Action is the title of the textbook, title of the chapter. It will cover a few things such as the accounting process, who some of the users are, which we also talked about yesterday, and some of the accounting reports. So this first PowerPoint shows you the steps in the accounting process. The first one being identification, second one recording, and the third is communicating. So the entire process involves these three things every cycle. Identification. First of all, you have to identify if the transaction actually exists. So we only record financial transactions. We do not record non-financial transactions. Example, CEO came into the building 9 o'clock. We don't record that. We record if he spent $1,000 on something, right? Financial transactions. So you have to identify if a transaction has actually occurred or not. That's your major step. And once you know which transaction has occurred, then you can move on to the next step, which is the recording process. In the recording process, we have three different steps. We've got the recording of actually recording it, classifying it, and summarizing it. Yep. So we'll talk about those things as we process through this chapter, and then we have the communication concept, the step as well. So some of the questions that internal users ask. By the way, remember some of the users we talked about yesterday? What users did we talk about?
Your boss.
Your boss. Okay. So management. Who else? The government, investors, creditors, employees, right? So these are some of the users we talked about. Out of those users, which ones do you think are internal? Management and employees. They are definitely internal. So some of the questions they may ask is there enough cash to pay the bills? Is there enough cash to pay the employees? Can we give bonuses? All of these things are internal questions that accounting can help answer as well. And then we have some external users, such as the government, the investors, and the creditors. And they may ask, is the company making enough money? Should we invest in this company? Can this company grow? All of those questions are external users' questions. So this is the real crux of today's chapter. The difference between bookkeeping and accounting. So these are two different things. Where does bookkeeping end and where does accounting start? Of course, there's lots of overlap. However, there are some distinct differences as well. So bookkeeping involves completing journal entries, posting those journal entries to the ledger, preparing trial balances. This is all part of bookkeeping. So if you go back to the slide where we were talking about the accounting process, identification and recording is bookkeeping. Okay. Bookkeeping stops at summarizing the information, which is trial balance. And then the accounting really starts. So those are two distinct functions. However, to get into accounting, you need to know all about bookkeeping. This is the basis of accounting. Okay. So if you took grade 11 accounting, all of that was bookkeeping. We're going to cover the bookkeeping in these 4 or 5 chapters and then move on to a lot more about the accounting. Accounting includes all of bookkeeping, but it also talks about judgments. Remember the professional judgment we talked about? Preparing all the financial statements. So that's the accounting part. Analyzing and interpreting all those statements. Does the company have enough cash? Can the company survive the next 10 years? It also includes communicating with the users. So the accountant's job is to communicate that information that they have come up with the users, internal and external. Of course, they communicate once, right, using annual reports, but they can also communicate in other means through meetings, emails, correspondence, and so on. Okay? So you may not know what journal entries are, but I'm just telling you that these are part of bookkeeping. However, a good accountant always knows their bookkeeping really well because that's the solid foundation. That's like the arithmetic of math. Right? If you have to understand the addition, the multiplication, the subtraction, the division before you can understand algebra. So this is what it is. You have to understand bookkeeping before you get into accounting. So there are internal accountants and external accountants, and we talked about this yesterday as well. Internal accountants are those people who work for a company. External accountants are those people who are outside the company but help the company prepare all the bookkeeping, all of the financial statements, and all of the accounting. There are 5 types of services that external accountants offer. And this is what they offer. They offer compilation engagements, they offer review engagements, they offer audit engagements, they also offer consulting, and then there is the tax consulting, which is a very specialized area that they offer. So these are external accounting services, external to the company that you own or the company that you work for. Does that make sense? Does that make sense?
Yes.
So some of the GAAP, the generally accepted accounting principles, I know we'll go over these things again and again, but some of the basic ones are the cost principle. It states that you must record all your assets and liabilities and equities at the cost principle using the historical cost. Okay. So the cost principle dictates assets, but of course the rest are implied, because if you are recording assets at historical cost, you're obviously recording liabilities at historical cost as well. So this is something that has changed with IFRS coming in. You have a choice of cost or fair market value. Again, we'll talk about those concepts as we progress through the course. The second assumption is the going concern assumption, critical. You must assume that the business will survive. You have to be optimistic. You don't go in there and say, the business is not going to survive, so there's no point in doing bookkeeping. There's no point in doing accounting. There's no point in running a business. You must assume that it's going to survive. Going concern assumption. Chances are that it will survive the at least one more year. Monetary unit, remember this is where the identification comes in. Only dollar transactions, financial transactions are to be recorded. Nothing else. Economic entity. Every organization is an entity on its own. An individual is an entity, a company is an entity, governments are entities. The word entity implies everything. So if you're an entity, you must produce financial statements. So we'll stop it here today and we'll continue the lesson tomorrow. So you will obviously continue with your homework and assignments, but we'll stop the lesson today at this point.